Emerging markets are under pressure. Last week, JPMorgan's EM Currencies Index saw the worst weekly decline since the 2016 US election. Investors are questioning whether EM is still the place to be amid a strengthening US dollar and rising rates from the Fed. Joining me now is Michel Perera, Chief Investment Officer for Canaccord Genuity Wealth Management. Michel, thanks so much for coming in. I want to get on to emerging markets in a minute, but let's just start out with the house view. What are you looking at in terms of asset classes at the moment?
Well, we still like equities. Equities are still the place to be because we have not finished with this cycle yet. The signs of a US recession are still very far away, whether they're technical signs or fundamental signs. And we still believe that earnings are continuing to grow, perhaps not quite as fast as they've been growing this year, but they may actually be double digits next year as well. And fundamentally, there is nothing wrong. The rest of the world is also doing well. It's not just the United States. So we still like equities.
And which sectors specifically are you looking at?
Well, I think it depends what your time horizon is. In the very short term, it looks like the industrial sector, the cyclical sector, has suffered quite a bit. So there may be a rebound in that, which would favor parts of the world like the European area, the Eurozone and Japan, which are quite heavy in those cyclicals. If you look at it a little bit more towards the end of the year, in the fourth quarter of the year, you could have a significant rebound in the US market due to the fact that after the midterm elections, there tends to be a very strong market. Because people have worried previous to the midterm elections. Is that going to mean gridlock? Is that going to mean a difficult environment for additional stimulus for the economy, etc.? And there are some sectors that we have seen recovering, like energy has recovered quite a lot. There are some sectors that we like. We still like healthcare and technology, and we like the financials as well. So there's quite a few things to like.
So what are some of the biggest concerns that are raised by your investors? What are those frequently asked questions? They're always coming to you and saying, I'm concerned about this, or...
Well, I think the biggest concerns always seem to be political. And no matter how much we try to tell clients that political issues don't necessarily always get reflected in stock markets and shouldn't drive stock markets, they are still concerned about political issues, whether it's...
You're talking about in the US?
In the US or in Europe or in other parts of the world, and obviously in the US is quite dominant right now because of the very strong trade tactics used by Donald Trump and his team, as well as obviously some more bellicose scenarios where you could potentially have a problem with Iran, or the North Korean problem is not completely resolved. So those things worry investors. But of course in the UK people also worry about politics, whether it's Brexit or the potential arrival of Jeremy Corbyn at number 10.
And what do you make of the inflation picture in the US? And where do you think we are in the economic cycle? Do you think there's any signs of a potential recession in the next couple of years? And do you think that will be induced by the Fed?
Well, it would be induced by the Fed if inflation got out of control and they had to step on the brakes. But it seems that for the time being, inflation's actually quite well behaved.
So you're not concerned about rising prices?
It is rising. Inflation is rising, but it is rising to a degree that is so moderate that it's not necessarily going to require a recession to get rid of it, the way in other cycles the Fed has done it. For instance, to give you an example, we're talking about wages going up in the 2% area, 2.5 something, between 2.5 and 3%. It generally takes 4% wages plus in order to get a significant inflationary boost out of wages. So I don't think we're there, and we're unlikely to get there in this cycle, because the structural deflationary factors are still much, much stronger than the cyclical reflationary factors.
And what's your view on the US dollar? Because it was trading within a tight range, having depreciated significantly last year, and now it seems as though that trade might have be showing signs of reversal. We're seeing the greenback pick up slightly. After, of course, we've got the US 10-year hit that 3% yield. Do you see there's further upside for the US dollar in the immediate term?
In the very short term, there might be, but I think as we look towards the end of the year, the US dollar should probably continue to be weaker because we're not completely in a different situation as we were before. There has been a covering of short positions, obviously, and there has been a technical rebound in the dollar, but fundamentally things have not changed. The rest of the world is growing. It's not just the US that's growing. That means that US capital is flowing to the rest of the world, and the US still has a very heavy trade deficit, which they're obviously trying to deal with in their bilateral and multilateral negotiations with NAFTA or China or whatever, but that's going to take a very long time to get fixed. So the dollar would appear to us to continue to be weak this year.
So presumably that bearish view on the US dollar underpins your constructive view towards emerging markets?
That would help, but it's not necessarily the only reason. And the emerging markets of today are not the emerging markets of 15, 20 years ago, which were commodity exporters, very heavily dependent on foreign capital and competing against other parts of the world, and therefore extremely concerned about the value of the US dollar. Right now, most emerging markets are driven by domestic consumption and the emergence of a middle class in a lot of these countries, and exports still matter, but much less than before. China is the perfect example. The percentage of exports in the GDP has fallen very substantially.
So we heard from the Fed Chair Jerome Powell just overnight basically saying that tightening from the Fed will be manageable for emerging markets. Presumably you agree with that?
Yes, I would think so, because if you have a mildly softer US dollar, then the emerging markets are not necessarily going to suffer from that. In terms of tightening, they don't have to tighten as much as the US does, but they will probably everything else being equal, they will probably start tightening a little bit. But bear in mind that emerging markets have mostly been cutting interest rates until recently. So there's still quite a bit of stimulus involved in their economies.
Well, if you look at Argentina, we saw them increase their interest rates from 27.25% to 40% in a completely shock move there. What did you make of that?
Well, Argentina is a little bit of the exception that confirms the rule that emerging markets are no longer the way they used to be. There are still some situations where you have the traditional balance of payments problems and traditional twin deficit problems in some emerging markets, and Argentina is one example. It was too good to expect that Macri could come in and suddenly fix all the problems that have been festering in Argentina for many decades.
And if you want to get invested into emerging markets, do you think that it's better to go through equities or via the currency markets?
I would suggest equities rather than the currency markets. The currencies are probably the most unpredictable thing in emerging markets, and therefore if you're buying government bonds in local currency, you may actually be subject to quite a bit of volatility, whereas the equities actually reflect the growth in those underlying countries, which has not subsided at all.
And are there pockets of EM that look particularly attractive to you? Because there are certainly areas where there is reason to be concerned. If you think of Russia, for example, with the sanctions, and we saw a massive sell-off in the ruble and the MICEX.
Well, Russia is a market which has been cheap for a very long time, is probably actually at its cheapest in a very long time now. And therefore, if you want to be brave, you might as well go ahead there. We think that areas like China might be a little bit more interesting because fundamentally you've got some very attractive companies. You've got 40% of the stock market is basically technology, and there's a lot of domestic growth now. So we'd be a little bit more interested in Asia rather than in Russia. But Brazil is recovering. It has had a very serious problem, and it's now recovering from that. And I think that the combination of these different markets might actually be interesting.
And on China, obviously the trade war story has been dominating the news flow. How do you see that playing out? Do you see that ultimately getting resolved?
Well, it's not in the interest of the US to put a lot of trade tariffs on their imports, because it was actually feed into inflation. And I think the threats are designed to get the Chinese to make some concessions, but those concessions will take quite a long time to come, and the negotiations are probably going to be quite lengthy, and there will be headlines that will move the markets. But ultimately, the strength of the two economies is not going to be affected, because even if you consider trade tariffs, they're a minuscule percentage of the GDP of the two relative countries.
Okay, Michel, thanks so much for your time. That was Michel Perera, Chief Investment Officer for Canaccord Genuity Wealth Management. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.